The SharePickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Steve's on mute. Steve, why are you on mute?
That's not going to work, Steve.
Steve, we don't need to see you. We need to hear you. It's a podcast. This is the guy in audio visual.
There we go.
There we are. Let's start then. Welcome to the Weekend Podcast. It's an Easter special. Steve, cue the jingle.
Easter special, yeah.
Oh, I was expecting a higher, production quality on that, to be honest.
He's been spending all day on that. That's quite bored.
Steve, to be honest, that 300 quid wasn't worth that. I thought it was a bit more.
Where did the 300 quid go?
Exactly. On that jingle. There we are. You get what you pay for, I suppose. I didn't pay for that. Anyway, boys, it's a weekend podcast. It hasn't been a week. And do you know why they have Easter eggs? Do you know why they have Easter eggs? For Christmas.
What's that?
Well, back in biblical times, used to give Easter eggs to each other. Massive Easter. Back then, of course, with lack of inflation, they were huge. And now we've got shrinkflation. Right. They're tiny. And, back then they were nothing, but they used to, all the tribe, Jesus and the guys, used to give eggs to each other. Cadbury's, right. But they weren't little then, they were massive. But, of course, it's gone through shrinkflation and all that stuff. So that's why the tradition is carried on, giving Easter eggs, chocolate eggs, Cadbury's chocolate eggs. It's always, been on for years, that has.
Right.
I've no idea.
Do you steer away from religion?
I've no idea what the relevance of chocolate Easter eggs are at Easter. Do you have any idea?
No.
No, there we are.
No.
And everyone's sort of brushed over it because these companies, like Cadbury's and the like, are making money from it.
Wait, it is that. It's like Santa Claus being red is due to Coca-Cola, isn't it? It's like the Easter eggs is due to Cadbury's or someone, isn't it?
Yeah, it's
marketing Easter.
Exactly.
Commercialising Easter.
I do think the amount of chocolate on an Easter egg is a perfect Saturday night treat.
Oh, Steve, years ago, they're getting smaller though, aren't they? They are getting smaller. Yeah. But
it's enough. It's enough for now, Do
you know do you eat a whole Easter egg in one go?
Every weekend.
Clearly. Wow.
Have you seen the price of cocoa, by the way? Cocoa's doubled over in the last few weeks. It's gone from $5,000 a ton to $10,000 a ton. So Easter eggs next year are going to be very expensive. Very expensive. But, that's what we do. Commercialisation is amazing, isn't it? What they do is hijack a religious sort of festival or something, and they brand it up, and they sell it to you, and they say, oh no, this has always been tradition, yes. Jesus and the guys giving each other Cadbury's cream eggs and all that stuff. Oh, yeah. Very popular back in the day, that was. Oh, yeah. Crack on with the guys. Just buy the eggs, yeah, and shut up. Don't much, apparently about rebirth, but somebody said 10 years later about rebirth. Jesus coming back from the dead, that's apparently. And he rolled a big stone away from the cave, apparently. So that's a very tenuous link.
To be fair, if more religions followed the thing of Easter, of just giving each other chocolate eggs, I think we'd be in a better world, wouldn't we?
Yeah, but the Christian festivals are all about stuffing your face full of stuff, aren't they? They're all about it. Everything has been lumped in with just Christmas, stuff yourself till you're sick. Easter, stuff yourself till you're sick. Those two.
Yeah.
Anyway, boys, the market. If you listen to this first time, it's not long now. If you haven't subscribed, please go to sharepickers.com/subscribe because the website's coming along nicely. Guys, you've got access. I know you've sort of checked it out.
Yes.
Stephen, have you checked it out?
No.
Excellent.
I'm not even going to lie.
Yeah,
no.
Good. Well, attempt to lie, Steve. It's funnier when you attempt to lie. Let's try that again. Steve, have you checked it out?
Yeah, it's brilliant.
Yeah, okay, which bits do you like?
The login I thought was particularly.
You like the login process?
I really like the login part.
Yeah, I haven't looked at that.
Smooth.
Yeah, I haven't upgraded that, Steve. That's still the same, the login process. Other things on the site.
I'm old school, like the old one.
Oh, yeah. Okay. But but what I've done, apart from other things, is I've got my watchlist on there. You've got the webinar on there. There's blogs where I buy and sell stocks. I put blogs up. But I've created this thing called StockScores. And so I'm obsessed with finding a super stock. A super stock is a kind of stock that's 10 bags. And it can be done because they have all these traits, that all the last 10 bags they're all traits. They all started below 100 million market cap. So why look elsewhere? Elsewhere? There's plenty of opportunities sub 100 million market cap. You can't be dabbling all over the market looking at this stock, FTSE 100 companies down to micro cap. There's too many. It's too many. It's like, if you're going to... Do you know what I quite like? I wear the same style T-shirt, not the same one, every day,
Right.
pretty much. And I've got about 20 of them. And I just know they fit. Okay, different colours. But even that, I'm thinking, should I just go black or just dark blue? So simple. Because you know what you're looking for. And you put it on, you're happy with it, you know? It's like...
Mark Zuckerberg wardrobe.
Yeah, what does he wear? Just hoodies, isn't it?
Yeah, you would just... Oh, no, it was Steve Jobs, wasn't it? He just wore that black T-shirt the whole time.
Yeah, but you realise you shouldn't spend time on stuff that's not that important. I'm a 53-year-old bloke. I don't give a toss about fashion. You know, it's not my thing. I'm not spending. What should I wear today in the office on my own? Ooh.
When did you stop caring about fashion? I have interest. What year was it?
Ever since I've known you.
Yeah. No, I used to be
about 25 years.
I used to, try it a little bit. I used to try and go with the trend a little bit, but it's held no fascination with me. Never, ever. And so I think, anyway, what I'm saying about the markets, if you know 60% of the biggest winners come from sub 100 million market cap, spend your time fishing there, in the waters, in the small pond where the big fish are. Or there could be big fish. There are going to be big fish.
I have a question about those.
Man at the back with the big ears, yes.
Okay, Steve? The old ones are the best.
Yes, man with a lisp. Go.
Yes, right. I mean, it's an amazing thing because the time you put in, the legwork you've done. Thanks very much. That's good. I don't know quite how to use it.
There'll be a video on that. So essentially, it starts off.
Yeah, I know.
It's 100 stocks, right?
Yeah,
and they're ranked by the most important metrics of all.
I get that.
Yeah. So first of all, you'll see the sort of list there of all these companies. Now they've all got to be generating revenue because I know a lot of people listening out there will be trading these oil and gas stocks that have no revenue, or these biotech companies hoping to become rich because they've got the next cure for cancer. But you know what? That is not where the sustainable money is made. The big winners, and I'm talking about 1,000+% over many years, are revenue generating stocks. The revenue is growing, that drops through to the bottom line, the cash, the profit, the cash piles up, and they do that multiple years on a trot. So that's what you're looking for. So these metrics are based on that, And by the way, I mean, there's going to be a month where I open the membership thing for, and then there's already several hundred people on the waiting list. And I can't have too many because it becomes an admin job. People forgetting their login and password and all this stuff. And when you get hundreds of people doing that, it's like literally, I'm not looking at my stocks. I'm just dealing with admin rubbish, So anyway, so it'll be limited. But yeah, so you've got a list there, all ranked, okay? And you click on a company, it's got company information, the logo, clicks through the logo, it goes through the company website, and then you have the information like market cap, revenue, all that stuff. Is that quite simple so far? It's just got the basic company information you want to know, So,
got it.
Yeah, and then essentially what you're looking for at the top of the list, what it is, and I'm going to keep a track of the top 10 stocks in this company. If they stay up there, how do they perform? Because essentially, it's dynamic, you see. So, for example, there's a company on there today that was in the top 5. Now, every night, the share prices are updated, the shares in issue updated, and so that affects if a company rises quickly, for example, and it was, ranked quite highly on growth value, it'll drop because its valuation's gone up. It's less potential, you see, and so it'll drop down the scale. So the companies at the top there have everything. They've got good growth, good value, they're healthy, they're efficient, they've got momentum in the chart, and they've got potential. That means the broker sees, potential of more than 40% within 1 year. Mm-hmm. So, and that's the kind of thing you're looking for, because you do 40% a year.
But,
go on.
But there, what you're always looking to do is scale in, isn't it? So
yes. Oh, do you know what? Yes. Ooh.
Love a bit of scaling in. This
is one thing I've always right. And in the bull market, I've had to adjust a heck of a lot in the bear market. It's different market completely. It's like how can I liken it? It's like I suppose it's like being David Beckham, right? Before that Euro Cup, where was it? Euros or where he kicked that guy? Was it Euros? Was that when
World Cup? World Cup '98.
The World Cup '98, where he was loved and adored. And then that's the bull market, Can't do anything wrong, pretty much.
Yes. And then overnight.
Yeah, then overnight you become the villain. That's the bear market.
Right.
And you have to adjust a little bit, investing. And so it's really that. So, and essentially, this is, I'm releasing this book. I'm finding it hard towards the end, finishing this book off, because it's about, resources and stuff I use and all that stuff, and I'm finding it a bit clunky, really.
Just put the end.
Yeah, that's it. Halfway through the sentence. I'm bored. I'm off to look at some stocks. So cheers. Yeah.
Bye.
I didn't know how to end this book, so the end. What was I saying?
My question was about scaling in.
Oh, yes. And so in that book, I basically say, private investors lose money for two reasons. Steve, tell us why.
They gamble. They don't put a risk strategy in place.
They risk strategy in place.
Yeah.
Steve,
They buy at the wrong time. They buy at the wrong time and they sell at the wrong time.
Yeah,
There we go.
Can we try and form a sentence here, Steve?
I can try.
Yeah.
Start.
You said it before. You said it to me on text. That's why I asked you. I wasn't trying to set you up for a fall there. You said before, essentially, people don't know when to sell. And that's the thing, It's like, first of all, they hold on to losers too long, right? And not only that, they go too big. And they don't even average down. Like I say, in a bull market, it's not too bad doing that. But in the bear market, what happens is, you get it wrong, and you average down. And what happens to your portfolio? Essentially, that big stock you've been averaging down is dragging your whole portfolio down. And you get to the point where you've got a couple of winners in there, it's not going to make any difference because, it's like a boat tipping on one side, it's too much weight. You've got literally, it's going under on the one side. It doesn't matter, it's bringing down your whole portfolio. So the key is, first of all, these are two things. Holding losers too long, selling winners too early. So, first of all, start small. And you can do all the research you want in a company, but you may get your timing wrong and all that stuff. And then when you tend to go a bit too big, you think about the reward too much. And that's one of the things, focusing on reward rather than risk all the time. Focus on risk first. Say, how can I... And you tend to do this after bear market as well. How much am I going to lose on this? Now, if it gets to the stage where you're happy to lose what you put in, that's a small amount, and it's a small amount. So very sort of way you are not over-risking, Now, if it starts going in the right direction, and this is why I look at microcaps, because if they start going in the right direction, you're talking about a multiple return on your money, potentially. That's several 100%. So there's plenty of time to realise there's a winning stock. And you do realise that you've had stocks, we've all had stocks, where you pick it starts going in the right direction, almost immediately or within soon, and you realise the momentum's there, they release more good news, that this is now a winning stock. That happens. There's plenty of time to average up on those kind of things, and because you only start small, it's fine. Now, if it goes the wrong way, don't really matter, because if it's a good company, it'll come round, but you're happy to sit on, say, 20% loss if you 1% of your total portfolio value into it. It's nothing, is it? So, say you've got 100 grand in portfolio value, for example, and you put $1,000 into it to start off with. And if you're down by, 20%, you're down to 200 quid out of 100,000, it's not going to hurt you. You're not going to lose sleep over that. But then think about the risk first. Start small, think about the risk first. And then,
but how do we then use the stock score? So say you say, that company's top 5 now in StockScores, and there's a metric.
So what's that saying is basically they are the best risk-reward profile companies out there. The ones at the top.
Right.
So you are seeing.
To use your example, put $1,000 in that out your portfolio, whatever, lovely, and then, but I want to ultimately put, potentially 5-10% of my portfolio, because I like it, I like the numbers, I like the way, the fundamentals, etc.
Okay, here's how to do it.
How do I do that?
Yeah, here's how to do it, Peter. SharePickers.com/subscribe. Anyway, so here's how to do it, right?
Yeah.
Hey, Steve, keep doing that every 5 minutes, yeah? Like an audio indentation. You can do that, can you, Steve?
Yeah, rather not.
Oh, thanks. Start off, right, with 1%. Listen, Steve. This is very simple, right? It's called the 1-20-10 situation, or the 1-10-20, up to you. It doesn't really matter. So, 1% in total portfolio, right? You put a stop loss 20% below that, all right? If it rises by 10%, you move the stop loss up by 10%, then you invest another 1% of your portfolio, putting a 20% stop loss below that. You see? And you keep moving that way all the way up. And so you're only, you're hardly risking anything and you are increasing your reward potential, but your risk isn't going up because every time you move up, for example, you got another 10%, and all of a sudden that first investment you move the stop loss up. It's a risk-free investment. The other one it's got 10%, and the other one's got 20%. So basically, 30% of 1%. That's what you're risking pretty much any one time, and you keep doing that all the way up. I mean, all the way up. Yeah.
And then, so what are you then scaling in? What?
So 1% every time. Every time it rises by 10%, but 1% in. Yeah.
But some of these small cap stocks might go 20% in a day, 25%. So you're going to put another 2.5% in. If
it spikes like crazy.
Yeah, exactly.
Slow
you
down.
Don't do that.
Don't just go crazy. Yeah, let it settle down a little bit. Because as long as when I say 10%, I mean that's minimum. So it's 15%. It's fine. Then put it in. If you can still go. But these stocks here are not about pop and drop stocks. They're about sustainable rises for many years. So you've got plenty of time to scale in. This is not about making millions in 2 months.
But they might release some news that's like, oh yeah, that's a game changer, and they jump 20%, 30%.
That's fine. It just shows you're in the right stock. Don't worry about that. Sometimes that'll happen. You want as a good good problem to have.
But do you put more in on that day, or do you wait a bit?
Yeah, I would. Yeah. If you come out with good news, it's going to rally. You've got something already up a little bit. Yeah, I would. But also put that stop loss.
I would what? I'd wait.
No, I'd put a little bit in. For example, do you know the best thing to look at is company news, by the way. I mean, proper businesses. I'm not talking about pop and drop stocks here, hope potential stocks with, you can get 100% in a day and it'll come back down, say 90% next day, whatever, because they do a fundraise. I'm talking about sustainable revenue. The thing to look for are trading updates. Okay, that's the thing to look for. Not interim results or final results, because basically what trading updates do, they pre-flag what's coming up in the final results or interim results, and they release a trading update maybe 3 weeks, month before. That's when you get the good news coming out. So, and then all of a sudden, then that's reflected in the fuller results.
So, just a summary then.
Yes.
So, where you saying you buy and sell? So you sell at the bottom.
I don't want to
buy
sell
at the top.
Yes, Steve. That's it. Right. That's it. Finally,
so you're buying when it's going up. No. That's right, yes. You're buying when it's going up, you're selling when it's going down.
Well, I'm not. I don't want to sell. So basically, if I look at something like JD Sports, for example, it's amazing stock. It did 13,000% or something ridiculous. It did about 200% with not even more than 10% pullback, right? So it did 200%, and then it had a couple of big pullbacks. So literally, once you cover off, once you get to the point where you have a risk-free investment, where it's gone up like 20% or 20% or more than that, 25%, whatever, just more than 20%. And you cover off where you bought at. It's a risk-free investment, And you can choose to move that. If it shoots up 100%, of course, move it up a little bit. So you can only make a profit. That's a phenomenal situation to be in. You can only make a profit. Even you get the risk-free investment stage, you can only break even. You've taken the loss away from, you've removed the risk completely. Now, unless it gaps down, and that does happen in crap pop and drop stocks, but it generally doesn't happen in good businesses that are growing, and they've been growing for a while, and they're building sustainable. You don't have that gap down nonsense, unless a CEO, burns down the building, they make the widgets in or something. It doesn't really happen, or CFO does something like, is putting cash in his pocket. Doesn't happen very often. So those companies, they don't really gap down. So as long as you cover off that initial, if you get 20%, for example, or 21%, that's minimum. 20% up, you've got a risk-free investment there. Take that opportunity to lock it in, risk-free. Remove the risk, all you got is reward. It'll transform your voice. Because the thing is, people understand, it's not about making money. It's about not losing money. If you don't lose money, what's going to happen? You can only break even or make money. There's 3 parts of the dynamic. You remove the loss bit. So that first 20% is crucial.
Yeah.
Once you got that locked in, you can just sit back, relax, and put your legs up on your deck chair and drink your cocktail in your living room and pretend you're on a Caribbean beach. Yeah,
I can't be the only person. I'm sure Steve feels the same. Like I keep looking back at the last 2 years, and go, man. I mean, it's gone the wrong way.
Yeah, but it's taken. Do you know what? For me, it's taken the bear market. I said I've learned more in the last 2 years than I've learned in the last 12. Absolutely. Yeah. And I know now. Listen, I did well in the bull market, but I'm now looking forward. I'm going to do super well over the next few years. Absolutely super well. Like a super
well.
Yeah, super well.
Right.
Yeah. Because
sadly, we've got no more money left to go.
No, I mean, yeah.
Do you know what, Steve? Most of the stocks you got will bounce. I realised, but when I was cutting and saying you got to cut here, you got to cut. I mean, I didn't cut early enough, and one of the things, one of the reasons why I didn't cut early enough was I almost believe, you believe in this nonsense. I'm investing in micro cap stocks. They are businesses. But they're not big, mature businesses. They are still immature, and they're growing. So they're very volatile. And so it's not when you see these quotes, and I sort of believe these quotes, oh, you always have dips in the stock market, just hold on and go for the ride. Yes, if you're holding sort of Amazon or whatever, or General Electric or something like that, or like a Unilever or AstraZeneca, fine. This is not that market. It's a lot more volatile. So, in a downturn, you should cut. When you realise downturn is happening, somebody's like, oh, I don't care, I like this business, I like this company. No. Never fall in love with the stock or the story, especially in micro caps, because it's brutal out there. They sell off a lot faster, but they also rise a lot faster. So we are coming to the back end, but the good news is Q2 now, guys, coming to Q2, and we've got ISA allowances being used up, a new financial year with more people put money in ISA, and we've got interest rates coming down in June-ish. That's all going to help. So I think the pain has been had. The bear's bitten the arse off us, but now literally we're literally patching up the scar on our backsides and legs, whatever.
Okay. I know what you're saying. We're not investing in the Unilevers of the world, but equally, I don't know, Trufin, XPF. I feel like they have a solid business case.
I agree.
Yeah. Okay.
No,
like
I
totally agree with you. The pump and dump, the pop and drop, resource stocks and all that. We dabbled with them a few years ago, didn't we? And they made some money. It was good. But no, all that I get that. But the businesses that the micro caps, small caps that we were or are invested in, I don't know. I still maybe blindly sort of like championing them, but I think. To me, they still are decent businesses.
But they are.
Those ones those mentioned. Yeah.
They will all rise, okay? They will all rise. Some of these stocks, a lot of these micro caps, they literally are so undervalued. And the UK market as a market is so undervalued. And it'll turn round. It will. I heard reports now, some saying, is the AIM market broken because there's so many companies delisting? No. This is how it should work. It's a natural function of a bear market. All those companies have been living on AIM, on free money placings for years and years because interest rates were very low and there's free money. They're zombie companies. The share prices rose, but their operations weren't improving. They were never going to make money. Some of those companies have to delist, and then you get a smaller pool of higher quality stocks on AIM.
Is that happening? I mean, I don't know what the number of stocks there are.
I mean, look at C4XD. I mean, a good company. They perform quite well, okay? But they're a cash-hungry company, and they perform very well. And they realise, because of the bear market, their valuation has been knocked, and they can't raise as much money as they want to. Now, in the private markets, that wouldn't happen, because they haven't got a share price, pretty much, and it's not volatile. So they're suggesting maybe, I don't know what the net assets are, but I mean, if you look at them, they probably think, well, our assets and everything we're worth about 100 million, but yet the AIM market is valuing us at 20 million. We can only raise money on that valuation, so it's not good for us. And so that's what happens.
That obviously that news broke this week, and that was one of my stocks that still sat there in the fun corner. So a few percent of my portfolio though still, honestly, I hadn't really ever considered that could happen on a stock that is, or for a company that is doing well and is going in the right direction. Yes, they are burning cash, but I mean, they got paid 11 million quid the other month from AstraZeneca. Yeah. I mean, they're not a fly-by-night kind of shady company. They actually genuinely are a good business.
Yeah. And also, I talked about this with Vadim Alexander, head of healthcare, and he said, it's a bit late. The market's bounced. The bottom is in. It's like, we are in recovery mode. Why didn't you should have done this? Maybe, it's almost like they're going to rally now and miss out on the rally. So I think they mistimed it completely. I know you can't time the market, but I think that's a bit short. Unless they've been offered, privately, a fundraise. A lot of money. A lot of money some way, unless they've been offered that.
Well, the two major shareholders are in agreement, so there is something going on, isn't there? They've been obviously given some assurance that it's a good move. So, it came as a bit of a shock and a bit of I mean, it's like I say, it's not a big part of my portfolio, but it's like, I felt the story was ever evolving, and it was one of those ones that could come good.
Yeah,
pretty good.
Let me say, the bulk of your portfolio, I mean, I think should be the fund. Should be, like I said, keep saying that to people. I forget to mention that because I'm all in micro caps. My biggest holding is a fund that holds FTSE 100 and FTSE 350 companies, the biggest 350 companies listed, and they pay a dividend. That's my biggest holding. It's about 28% of my portfolio now, I think it is. And I put 1% of my total portfolio into that every month automatically. In fact, that's 4% up now, so it's 4-5% up, so it's doing quite nicely.
My two Vanguard funds collectively have grown 14%, I think, in the last year. That's a nice little return, and
if you've been doing that, dollar cost averaging, as they say, every month, then you get a good average, and over time you do very well. But that's literally your retirement fund, And then if you want to make money to put more into that over time, you invest in microcaps, and there's always room. I always say, there's always room for a high potential pop and drop stock all the time, but you've got to not put too much into it. You've got to make sure they have cash. And you've got to make sure there's some news coming up, And if that can happen, then it's good. In fact, we've both invested in one of recently, Hemogenics.
Yes.
And they've just raised cash. There's a bit of... I guarantee that's the kind of stock that will pop like crazy. Whenever they release any news, it does like a couple of 100%. But it will be, it'll dribble downwards... Sideways, downwards. They release news, and I've looked at it some days. There was one back in the day. They did several 100% in a couple of sessions. And it is one of the stocks that will do that. But they've got cash, and they go into clinical trials. Any positive news now in the clinical trials will rally. So it's good to have, in the odd one of those, but they shouldn't dominate your portfolio, especially not in this environment, because I said, the valuations of these pre-revenue loss-making stocks. They're hardly, the companies are suffering, like C4XD is suffering. So it's good to have one or two of the fund stocks, but a majority should be the fund, and then, maybe 50%, if you're 50, 50% in the fund, and then maybe about 40% in decent businesses, generating revenue, growing, all that stuff, good valuations, and then maybe 5% or whatever in fund stocks, and maybe 5% cash. But that's me.
It feels like, like you say, things are turning, and the tide is turning, and things. I'm certainly getting a little bit more interested again, and seeing a few rises in stock prices, and it's hopefully a sign. Like you say, ISA season is upon us now. So,
Steve, what about you, Steve?
Yeah, well, as you know, I'm just putting money into my Vanguard now. I've moved over to Interactive Investor.
Yeah.
Which
and ironically, you're being less interactive.
Very much. But it's a lot cheaper. So it's an interesting platform because you don't, unlike Harry and Larry, where they give you an updated gains and loss through the day. They don't give you that. They don't give you your total gains and loss at the end of the day. So you don't have the.
But then because you're in fund, and what for individual stocks?
Yeah, well, I've transferred my whole portfolio over there. So.
Oh right.
No, but hang on.
Obviously, you see the individual stocks going up and down, but when it gives you your total portfolio, that doesn't adjust until the end of the day. So if it's gone down by loads, you'll be like, oh, that's okay. Then at 4 o'clock, you're like, oh my god, yeah.
That's because it's not. That's because it's not an ETF. It's not an exchange traded fund, so they do settlements after the close. So that maybe because of that. But Steve, the Vanguard. Are you in the Vanguard All Share Index? Is that what you're in?
No, 100% equity.
100% equity, yeah. It's got about 8,000 companies in there, Steve. Unless there's a nuclear bomb goes off, it's never going to drop that much. You literally across 8,000 companies.
That's my future now. So I'm just literally going to regularly put my yearly ISA into that. And,
What percentage of your porf is it ticking up, Steve?
It's probably getting up to about 80% now.
Wow. All right. Yeah.
Oh wow. Okay.
That's good though. I mean, you keep putting money in that, Steve. It's fine.
That's because most of the other stocks have almost gone to nothing. So.
I see. Yes, I see.
So that should balance out a little bit if they ever kind of recover a bit.
Yes. Yeah. Okay. No, that's fine. Yeah. No, that's good. Cool. Okay. So that's very. I think, lads. Any plans apart from obviously going to church like the Royals do, having people they put that on the TV. The Royals going to church. Is there anything more boring than that? That's a news item.
What time's it on?
How is that a news item? How is that a news item? People away from the people actually go and see them. Go to the church. I think, how bereft of any entertainment are these people's lives? If literally their Easter weekend they go and watch the Royals get out of a car and go into a building. It's like, what? These people, I don't know. They shouldn't be allowed to breed. The Royals, I mean, not breeding. Right. Okay, don't forget, sharepickers.com/subscribe. It'll be up very soon, and that's a list there of potential super stocks that will return you loads. Do your own research, of course.
Do your own research.
Because I'm still filling in data on it 'cause there's still a lot to go yet. So once I get that done and a couple of other things, then it's I'm gonna get it out there. Get it out there, man. You know what I'm saying? Any plans, Steve? The weekend? Any plans, Steve? Peter, Steve? Any plans? Mm-hmm.
I'm gonna see the royal family in church.
Lovely.
See you there, Pete.
I'm just.
Yeah, I'm giving Steve a lift.
Oh, let's finish on that thing. Okay, boys. Thanks very much, and speak next week.
Bye.
The SharePickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.